When it comes to Roth conversions, we do a lot more of them later in the year because we want to know how much income the clients have had coming in. Did they have an emergency? They had to make an extra withdrawal from the IRA that might curtail the Roth conversion coming down the road. So a lot of our Roth conversions are later in the year.
And welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning for your financial, investment, and retirement future. He is president and founder of McIntire Retirement Services. Chris McIntire here with us. Chris, we always appreciate the time, the information that you share with us, and of course, the listeners, the viewers of the program, helping people to further their financial progress, know and understand the things that we need to know and the strategies that are available to help us achieve our financial goals. Always great to see you. How have you been?
Hey, we've been pretty good here, Peter. As you know, we run a pretty busy schedule here, and when with the U.S. Team winning the Olympic gold in both men and women's hockey, I'm ecstatic. As you can see on the podcast, I got my Red Wings coffee cup out here today in extra support.
Yeah, Chris, big hockey fan, ladies and gentlemen. If you had not heard before or were unaware, and Chris, a pretty good skater yourself. I've seen some videos, even now, much better than I could have ever done.
Yeah, I was nursing a sore hip for about the last 6 months, so I haven't been on the ice yet this year, but that hip feels a lot better. And after some treatments, I'm hoping to get out there, if nothing else, get some rollerblading in.
All right. Well, wish you all safety and stay on the skates there, Chris. Well, ladies and gentlemen, we are here to talk about finance, not just hockey and skating. And right now, Chris, I think we are getting to the point where if we can't already say it, then it is coming soon. Tax season is over. And I think, everybody kind of breathes a sigh of relief once we get the tax prep and the filing and submitting behind us. But your tip of the week here is that tax planning is for the year ahead, and now is a great time to look at taxes.
Yeah, here we are, in the first quarter of 2026, and I've had a couple of clients already ask about Roth conversions and, hey, what do we do with the passage of the new tax law? And, heck, most of the people don't even have their 2025 tax returns done, or at least the returns that they're getting back. And, so I think we've got I'm encouraged that people are being a little more proactive here. And I think it deals with the younger side of the baby boom generation more so than the older side of the baby boom generation because, taxes have come down, they've lived in kind of a different environment. They might just be retiring now versus somebody, one of the earlier baby boomers, still might have a traditional pension and a smaller 401k because of that.
Yeah, well, I think, Chris, the first several years of retirement, especially, a lot of figuring new things out, not just lifestyle and what you're going to do to spend all your time, but the income, the taxes, the healthcare, the Social Security, the multiple different streams of income instead of just one pretty steady, predictable stream of income. You help people work through all of these issues that we don't want to get anything wrong.
Yeah, absolutely. And, there is no concrete set of rules that says you have to do it this way or you have to do it that way. Everybody's got money in different buckets. And, what do we mean by buckets? Well, you might have a bucket of IRA money, and that's where 90% of your money is. And then maybe you got 10% of your money in a different bucket at the local bank, your emergency fund, that type of thing. There are other folks listening to the show today that have money at the local bank, money in a Roth IRA, and money in their traditional 401ks or IRAs. So, depending on the situation we're looking at, that's how we do our tax planning approach is, all right, what do we want to do? Like I had a client the other day asking about, Roth conversions and whatnot on some money that they're not going to use themselves. And, we said, okay, well, then let's find the best vehicle if it's money you're wanting to pass on to, because, hey, we might want to look at buying life insurance versus a Roth IRA conversion. An example of that would be, all right, a couple wants to convert $20,000 of their IRA into the Roth IRA for their kids. It's like, well, all right, so you convert $20,000, and if you had to pay the income taxes out of that converted amount, maybe you got 17 that went into the Roth IRA. So you're behind the game. Where with life insurance, for example, if you're wanting to pass money on to the kids, that's income tax free. And that $17,000 might buy two or $300,000 of life insurance. And obviously you might have to fund that over a 5, 10 year period, obviously, or forever, depending on how you do it. But what are the specific circumstances we're looking at? And that's where we take that approach, Peter.
Different structures, different tools, different benefits and disadvantages, strengths and weaknesses for each one. We've got to weigh all of those and find which approach is right and best and most appropriate for us. And most of us, having worked our career, have not dove in and gotten as well versed as we need to make those kind of decisions on our own, to understand the tax strategies, the Social Security claiming timing, the order of operations of when to tap different accounts. And that's why, ladies and gentlemen, you need a guide, you need a coach, you need somebody to help you through it. You need your game plan for retirement. That is the written plan that Chris McIntire and his team there at McIntire Retirement Services will help put together with you and for you, and then help you implement and monitor if you would like. And if you would like to get that process, that conversation started, no cost, no obligation. It is a courtesy service that Chris offers to listeners and viewers of the program. So many have taken advantage, but so many more need to. To get that conversation started, all you need to do is pick up the phone and give a call. 419-332-0532, 419-332-0532. But bottom line here, Chris, as we were talking about kind of seeing the light at the end of the tunnel of tax season, is that tax filing is backwards looking. Planning should start now. Don't start thinking about taxes again next January or February. Do it while this fresh data is fresh on your mind. That is going to give you the best perspective on effective and efficient strategies for all the future years of paying taxes.
Yeah, without a doubt, Peter. And, when it comes to Roth conversions, we do a lot more of them later in the year because we want to know how much income the clients have had coming in. Did they have an emergency? They had to make an extra withdrawal from the IRA that might curtail the Roth conversion coming down the road. So a lot of our Roth conversions are later in the year, unless we get a stock market that, corrects 15 or 20%. That's a good opportunity to do some Roth conversions as well, because you can keep the same assets, just slide them over into the Roth, and hopefully they recover over there. And that helps you, kind of regain that tax hit. As we go forward into, 2026 and, looking forward into 2027 is, boy, there are a lot of advantages, toward putting money away for retirement. The government has certainly helped, open the door. And, one of the things is the 401k. And for, 2026, you can put $24,500 into your 401k. And I got to look at my note here. The catch up is an additional, if you're 50 or over, is $8,000. Okay. And for myself, I'm 60 years old. From 60 to 63, you can put in another $11,250. So, significant amount of money that you can defer, again, and sometimes it's a forced savings, and, 401ks, you're eventually going to pay the tax on that money, but at least they've got a nice door there to incentivize people to save for retirement.
Well, more and more, Chris, I think people are making the choice, or at least we have the choice for those Roth 401k contributions. And I know we're going to dig all into how the 401k and these retirement tools play into effective tax strategies. But kind of a new wrinkle for 2026, Chris, is if we are a high income earner, maxing out that 401k and taking advantage of those catch-up contributions. Like, I think the government did the math on this, Chris. Now, starting this year, those catch-up contributions are required to be on the Roth side.
Yeah.
Interesting wrinkle. What do you think of it? And does this mean that all 401ks now kind of de facto have to offer a Roth option?
Yeah, you would certainly think so, Peter. And again, I can't speak for every provider out there, of course. And we have our own 401k that we started. We transitioned from a SEP IRA to a 401k this year because it was better for the employees and so on and so forth. And even as the business owner, um, and that catch-up contribution, it does have to go into a Roth 401k, which means you don't get to deduct that contribution, but still continues to grow income tax-free. And for some of you, it's a good way to start on the Roth side of things. And I know from where I'm at, I have not always been the biggest proponent of dumping every dollar into the old 401ks and whatnot, and just delaying the taxes and building another tax nest egg, if you will, that can crack, right? I like having money outside of the IRA account. So that's where the bulk of my wife and I's money is outside of IRA accounts. I'll take capital gains taxes over income taxes any day of the week. Okay. Now, that being said, Peter, as you and I have been in business for a long time, we enjoy a little degree of success. So now all of a sudden, that 401k certainly makes a little more sense because of of tax situations, like you said, high income earners, and I think we would probably fit into that general classification of everybody's number for that is certainly different.
But
JP Diamond who of JP Morgan, that's a high
yeah,
income
yeah,
earner,
right. Yeah, yeah,
not
relative, right?
Chris and Peter.
However, when the government sees you're making money, there are things that they burden you with. They lay upon your shoulders. This one, Chris, again, I feel like the entire system of tax deferral, some number crunchers behind the desk at the IRS probably figured this out a long time ago, that if we let people defer, we collect more down the road. This is another example of that. If somebody's earning $200,000, and they're able to save 35,700 of that income to max out the 401k plus the catch up, then I think the government looked at that and said, well, we'll collect more now when they're earning high than what their living expenses are indicating to us we would collect in retirement. Go ahead and force the issue and make them prepay the taxes on the Roth side, right?
Yeah, yep, you make a good argument for that. And obviously there's politics involved in this. So one side says this, the other side says that. So they, maybe perhaps they actually came to some sort of compromise, which, they're not really well known for doing these days, Peter.
No, no, and it doesn't make it a bad thing. There are plenty of high income earners who are looking to prepay the IRS and get them out of their hair. So this is not a good thing. It is just a new wrinkle in the requirements that everybody should need to know if it applies to you. If you're over the age of 50, taking advantage of those catch-up contributions, which of course the 401k and the catch-up contributions, not only a good saving and investment tool, access to the markets, automatic contributions, but also it plays into the tax planning strategies. Now, one additional critical detail on the 401ks, Chris, and I know that this is also plan by plan, but it is something that people need to be aware of. If you are able to max out that 401k like super early in the year, give a moment's pause and check your plan documents to make sure you're going to get all of the match, right? Because some plans match kind of pro rata proportionally across all contributions. And if you put too much in too soon, you might miss later months in the year's available match. Some plans correct this, some plans don't. Can you talk about that?
Yeah, and as somebody who just recently set up a 401k, there are a lot of different parameters that the business owner could choose the way that they want to structure it. So, like Peter says, and Peter, I think just plain and simple, you're better off adding money into the stock market at regular intervals so that, out of your paycheck. So spread that out through the course of the year is typically best for long-term investors because you're buying more on the dips and less on the peaks. And if you're front end loading it, it might be when the market's real high. And, long-term investment, certainly does better dollar cost averaging over those pay periods. That's what I do with mine. Every pay period that I get, Robin puts a little bit of money in the 401k and, and off we go.
I'm glad she can take care of that for you.
She takes care of a lot for us.
Well, don't leave match on the table. Bottom line there, right? Not only, again, access to the market and investment power, but tax planning wise as well. Yes, those matched dollars will be taxable down the road. The company's nice enough to match for you, match your contributions. Generally, not nice enough to pay your taxes on those matched dollars for you. But again, building as much as we can, and then we will deal with the tax consequences on that down the road, which, Chris, it does kind of lend to the question of traditional versus Roth. Which side should you use? This alone is a big question these days. You crunch the numbers on this with your clients. You help them really arrive at more than just a guess. A concrete conclusion as to which side or maybe both sides could benefit them.
Yeah, absolutely, Peter. And looking at a 2026 tax guide here, if we look at and I'll just use married filing jointly because it's easy to just use one. If you get a husband and a wife that are both working and they make, say $150,000 a year, look, they're probably hitting that 24% income tax bracket. So does it make more sense for them to focus on the traditional 401k and lowering their income? And then as they retire, then look at structuring the Roth IRA conversions, So again, if you get somebody who, maybe it's only one spouse that's working, the other one's already retired, well, maybe it makes sense for them to utilize some of the Roth 401ks out there. Now they can always do a Roth IRA if they qualify for that as well too. So, a number of different methods. The nice thing about the IRA side of things is you get until April 15th to fund that, where your 401k's got to be in there by the end of the tax year. So the April 15th deadline gives you the ability to put some money into an IRA or a Roth IRA. In fact, we just had a client that went to the accountant and he retired this year or last year in 2025, retired in 2025, but worked most of the year. And the accountant said, hey, open an IRA for your wife and put $7,000 into it. And did a spousal IRA to help lower the tax bill for 2025 because they were trying to work through getting cheaper health insurance through the Affordable Care Act. And that's an income equation right there. So anything they could do to lower their income was advantageous for their health insurance premiums going forward here until they transition into Medicare, if that makes sense.
Chris, a lot of people kind of wonder, where is the tax form for the confirmation for the contributions that I did put in last year? And you noted you can make those contributions all the way up until April 15th for the prior year. So the form that confirms that does not generate until after the tax deadline. That throws a lot of people. They're looking for that form. You don't get a form for that. The confirmation goes to the IRS, right? Can you talk about the confusion there, and how do we then denote that we made these contributions?
Yeah, so you're doing your tax return with your CPA, and the CPA says, hey, put $8,000 into an IRA account or a Roth IRA account, and we'll put it on the tax return. And you want to make sure you get that done, obviously, and today it's pretty easy because we can electronically move money from, our bank account to Charles Schwab, Fidelity, T. Rowe Price, Vanguard, whatever clients are using. But the other important piece I wanted to tag onto this, buddy, was, not everybody can contribute to a Roth IRA. A Roth 401k provided by your employer, yes, but a Roth IRA has some income thresholds on it for single filers and joint filers. So, sometimes that's better that it comes later in the year after when you're sitting with the CPA and he says, you know what, you got paid that extra bonus this year, and that disqualifies you from contributing to a Roth IRA. So, you don't want to make that contribution and then have to back it out because you pay a penalty to do that. You're trying to save for retirement, get caught in a little IRS snafu there, if you will, and you don't want
trying to do all the right things and it goes wrong, right, Chris?
Yeah, and it's shaking my head because we sometimes have to help people correct some of those things as well. It's like, oh, you didn't tell us that you inherited 700,000 bucks or something like that. That's important information. So it does happen to everybody.
Yep. Well, Chris, another thing that I think people are confused about, even for higher income earners or people who are even no longer earning income, there is a perception that we can not get any money into the Roth. And what I have found is there is almost never a case where getting some money into more tax advantaged positioning is impossible. Can you talk about the different strategies for conversions or backdoor contribution conversions and how even people who think they might be eliminated can still take advantage?
Yeah, yep. And so a couple of these, I got to look at my notes on that backdoor Roth strategy. You know, so for example, Peter and I probably make too much money both where we cannot contribute to Roth IRAs. And I don't know Peter's situation, but he's obviously like the next Rush Limbaugh that we got coming out here.
Hardly.
Yeah. So, but what we can do is Peter and I could open a non-deductible IRA account where we cannot deduct the contribution going into it. Okay. But if we left that money sit in there, the growth on it would grow tax deferred. And then when we pulled it out, we'd have to pay tax on it. A backdoor Roth means you make that $8,000 because Peter and I are both over 50. I got him to look at me. Peter's not quite
Yeah,
50.
no,
So,
I'm there. I'm there. I'm
oh,
getting
okay.
there. Yeah, yeah, yeah. Not quite,
Look,
but it's getting short. It's
yeah.
Chris. Yeah, just turned 46. So
Okay. Yeah. So, if we on April 15th, we could put money into a non-deductible IRA account and immediately convert it into a Roth IRA. And we would want to do that before we invested it. So we would just open up our non-deductible IRA, put $8,000 into it, and then the next day we would want to convert that to a Roth IRA because we don't want it to sit in there and invest and grow because then you get some earnings in there, and it's best to not have that because it's just simpler to put it in the non-deductible IRA, convert it to the Roth the next day. That's a pretty popular strategy and something that Robin and I may do yet this year.
and a caution on that though is that if you already have other IRA balances, you need to be aware of that. And then Chris, again, kind of a newer rule that if you are of RMD age, the RMD is always the first money out. And so we've got to order things in the proper order of operations if we want to do some Roth conversions after RMD age. And by the way, the RMD can never be directly converted to the Roth. The RMD is not eligible for a Roth conversion itself. Still
Yeah.
ways to do it, but that can't be converted. So
Yep.
yeah, a couple gotchas there for people to be aware of. And I think, moral of the story is that there are very effective tax planning strategies available. You just need to know the nuances of all these rules. They're not necessarily hard, but you don't want to get anything wrong here, right, Chris?
Yeah, yeah, you're exactly right. And, I'll give an example of what Peter was saying in dollars and cents. So let's say your required minimum distribution was $10,000 and you're 75 years old. Okay. And you said to your advisor, hey, I'm going to convert $20,000 out of my IRA into my Roth, and 10,000 of that is my required minimum distribution. I just want to put that into my Roth as well. You cannot do that. Your required minimum distribution, RMD, cannot go into a Roth IRA account, converted Roth IRA account. Now, you
Yep.
had to take money over and above that. That's just what Peter was saying. And, Peter, let's not discount health savings accounts as well.
Okay.
Um, it's something that I like to fund. I've already fully funded our HSA account for 2026. We had some extra cash, so I finished up 2025 and I put 2026s in there. And in our HSA account, we keep a certain amount in cash, and then we have investments inside our HSA account, so I can buy mutual funds with the surplus cash. And the advantage to that is, the HSA contribution is tax deductible, okay, where the Roth contribution is not tax deductible. You have to pay tax on that, okay? And then the HSA grows and then you get to use it income tax free for qualified medical expenses like glasses and, scans and operations and, certain expenses. I don't think you can use it for supplements and, like your regular vitamins. We typically save ours and use it for bigger ticket items.
Yeah, and just Chris, again, different tools, different benefits and disadvantages. Always things to be aware of with all of these. And ladies and gentlemen, that's why you have to have a experienced, qualified professional guide, a coach, to help structure and navigate your game plan for retirement. If you'd like to get that put together, pick up the phone, give Chris McIntire a call, 419-332-0532, 419-332-0532, 419-332-0532. Now, Chris, I've heard like different opinions on when a Roth makes sense. And I've heard people say, it only makes sense up to a certain point for certain reasons. But to me, there are extended benefits with the Roth, not only the tax-free income, but the spousal income for survivorship for a widowed spouse, making that tax-free when they will be in a higher tax bracket. And then even as a legacy play for beneficiaries, all of these things are benefits. However, there are things to be aware of. The IRMA that can result from higher income, including the dollars converted to Roth, that has to be part of the consideration, right?
It certainly does. And IRMA relates to how much they take out of your Social Security benefit for your Medicare premiums under Part B. So for most folks, I think 2026, it's $208. Okay? However, if you're a higher income earner, that number can certainly grow. I can tell you, my wife, they take out about $600 a month, and I'm looking on my 2026 tax sheet is where that is. Yeah, so if you're, if you file a joint return and your income's above 218,000 to 274,000, it's $284 a month. So it's $202.90 for most of the American retirees until you hit some of those upper income brackets. And yep, so you want to watch that. And again, that's where you get those big Roth conversions that adds to that taxable income, or, a big down payment on a house or something along those lines, big expenditures.
Well, Chris, we've dove into a few of these in more detail, and time has gotten away from me. Another big takeaway with taxes: don't let time slip away. Be proactive. Be looking ahead. Make sure you are planning. You had a checklist here, Chris. Don't overlook taxable accounts. Am I maximizing retirement contributions? Should I adjust traditional to Roth contributions? Does a Roth conversion make sense? Am I positioned for efficiency across all tax buckets and brackets? Should I increase my taxable investing? Am I coordinating with those Medicare thresholds? All things to do while taxes are fresh in your mind. Don't wait until next January or February to start thinking about taxes again. As you file and get them completed and the data is fresh, that's the time to plan proactively. And Chris, you're a self-proclaimed tax geek, so I know this is a big angle in your conversations with your clients there at McIntire Retirement Services.
Yeah, it surely is. And sometimes we work directly with the client CPA to kind of run some what-if scenarios. And I'll be honest with all the CPAs right now, they're jammed until April 15th. So maybe you set up a secondary tax planning strategy over the course of summer and give them a break.
Yeah, they're chained to the desk in the dark like moles until after the tax filing deadline. But we'll have those conversations, Chris. We'll try to be proactive and then get into the schedule and have those conversations while that information is as fresh as possible. And again, ladies and gentlemen, it starts with planning and a comprehensive plan and a coordinated plan. Chris is your coordinator. He's your coach. He will help you structure that game plan for retirement. Pick up the phone, give a call, 419-332-0532, 419-332-0532, 419-332-0532, or McIntyre Services.com. And Chris, we always appreciate the time.
Yeah, my pleasure. Thanks, everybody. God bless America and go USA.
Tune into Chris McIntyre's full radio program and visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntyre. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.